Thank you, Michael. Hello, everybody, and good morning. Welcome to Year End 17. So what I really want to do is give you a little run-through topics we're seeing and also a run-through of issues a lot of you may realize or know about, but some of you might pick up some things along the way. At this stage, really, I think you're probably, as a lot of subsidiaries in Ireland, you're through your group reporting. You sent in your Q1 returns. I'm not going to talk so much about financial statements this morning. There isn't any real new news on that. We will be talking about IFRS 17 later, and I guess that's the new big up-and-coming change that's afoot. So really from what you need to do for the next couple of months is follow the rules. It's quite easy. It's all written down. Step one is, in terms of your regulatory returns, get your public QRTs and sections D and E of your SFCR audited. And you did that last year for the first time, so this is your second time through that cycle. Get your technical provisions certified by your head of actuarial function, your HOF, a central bank requirement. That's your second time through it. You did it this time last year. Part of the domestic actuarial regime requires that you get your technical provisions peer-reviewed, the so-called reviewing actuary. And depending on your PRISM rating, you do that every 2 years, 3 years, or 5 years. And for life people in the audience, this is year 2, because the clock started with Solvency II. But for non-life companies and reinsurance companies, you have a different clock. Your clock is aligned to old world. It was whatever you were on your old SAOs. But from a life perspective, we're expecting year 3 next year for medium lows being the first year a lot of you are facing into reviewing actuary work. PRISM high rated are doing it this year as well. Hey directors, good news. Plenty of things to sign. You sign a director's compliance statement for the Companies Act. You sign a director's compliance certificate and statement for the central bank. And you sign some accuracy statements on your RSORs and on your QRTs. You publish your SFCR, an annual event, coordinate that with group typically, and you publish the public QRTs that go with that. You submit your RSR. It's once every 3 years. Everybody had to send in one last year. This year you have a choice. You may send in an update, and if you read through what the update is update on things that have changed and the reasons and the drivers for that. Or you can send in a full RSR again. And in addition to that, the central bank, I'll mention it in a minute, has written to companies reminding you that they want to split the industry into 3. So they want a cycle of these 3 yearly RSRs coming in, spread through the 3-year cycle. So a third of you got an email, or a letter from the central bank saying, this is your year 1, please send in the full RSR. The other 2/3 of you got a one reminding you what year is your on-cycle RSR. We'll talk about annual QRTs later on, a non-trivial exercise, and you have to keep to the timetable. The timetable is 2 weeks shorter than this time last year. It will be 2 weeks shorter this time next year and continue to squeeze. So again, you need to be taking out a stopwatch and timing yourself and getting better each time. 6th of May is the red letter day. 6th of May is the full annual deadline. Everything has to be in for QRT, annual, SFCR, RSR, the actuarial opinion private to the central bank, and the actuarial certification private to the central bank, and the audit opinion private to the central bank. Keep an eye out for the other deadlines there. You have group reporting deadlines on top, and you also have Q2 happening on the 12th of May, not so far past the annual ones of the 6th of May. Okay, so what is going on? The central bank has given us plenty of information of what they expect on the QRTs, and we can't really feign ignorance anymore. Their latest and quite detailed feedback was through November. They had workshops with the industry in November, and they have published a workbook of Solvency II data quality checks they expect companies to use in checking their QRTs. I don't know how rowdy you feel this morning. Anybody shout out a number of how many checks are in that spreadsheet? There will be a prize. You get a free breakfast. Come on, be rowdy. Shout out a number. No, you won't be rowdy. 368. So 368 checks available there in that spreadsheet. Please write that one down. The other thing that's very useful in the spreadsheet is it gives you hints of the sort of words they use when they're checking data, and this will come up later. They have checks that have IDs on them, and they use the word coherence, they use the word completion, identity, and plausibility. Because this isn't just a trivial thing to say those, the sums work and just Form 9 equal Form 3. These are a little bit more forensic than that. And they've actually reminded the industry, and directors in particular who sign an accuracy statement, of the importance of accurate QRTs. They like data, they want data, they have a large data analytics team, and they want it to be reliable for the work they do. So I'm just helping echo that message. I took this from a central bank presentation at Society of Actuaries recently. I thought it was interesting. It shows of the approximately 190 firms in Ireland, how many send in how many forms. And they're color-coded by PRISM rating. So I think a reflective point that it was Graham Cherry made this presentation to the Society of Actuaries. He mentioned that they actually get more medium-low forms than medium-high forms, if that makes sense, if you look at the bars in between there. So often this is a reflection of how many countries you're in, as distinct from how big your balance sheet is. But again, you can see there's some PRISM high-rated companies sending over 50 forms in. And we do know some of those forms are very, very detailed and very long. Okay, and again, just to keep running this theme, where I used this slide last year, and it's actually still relevant this year, to remind you what happens to the QRTs once they go inside the central bank. The submission itself has some taxonomy checks, which is just a code check, really, on the data. And now it's an expectation that the companies are doing more checking than just the taxonomy checks. Within that, the taxonomy checks change over time. So the central bank can change them and use them in different ways, quarter to quarter. So watch out. You might be surprised of failing on a quarter where you did in the previous quarter. Once they actually hit the system, then there is a whole pile of automatic reports that just fall out of the system within the central bank. Quarterly trend checks, ratio checks, new data are queried, and they're typically sent to a human, typically your desk officer. And sometimes they'll actually bounce them straight back out to you. And over the last year, you would have seen evidence of that. We all got a lot of emails querying a lot of the returns. So that's the kind of automated process. And then the desk review themselves has a responsibility to work through your forms, understand them, and they may cross-check other information they have from you as an undertaking, and they might talk to you about them. And then ultimately, the central bank submits all the information to EIOPA, and EIOPA runs more validation checks. So come August, you might get another random query, which is typically triggered by EIOPA asking Ireland, hey, we're looking at this, it looks a bit weird, can you look into it, please? Okay. So again, this just shows you that the data analytics of regulators has increased hugely. Okay, now to jump gears a little, just to remind you what the central bank has been doing for the year. And here I think it's interesting to just watch how the central bank communicates with industry. As I meet them and talk to them, it's becoming clearer to me they really have three main conduits of communication. Communication method number one is they write a Dear CEO letter. It's also sometimes a Dear HOF letter. But that Dear CEO is a shorthand jargon for they issue an industry letter that's pretty factual and usually based on some work they've been doing, typically review work. The second thing they do is they put stuff in their newsletter. You have to read their newsletters, a quarterly newsletter, and that's a conduit they use to say that it's not big enough to be a Dear CEO letter, but they want to tell industry about stuff. And that's where you pick up a second level of themes. And the third level is they write to the company. And that's typically called a risk mitigation plan or RMP, and you will know it if you get it, and that tends to be very directional. It tells you what they saw, what they like, what they don't like, and what they expect you to do, and they expect you to reply with a written response of a time plan to resolve whatever those queries are. So again, those three kind of methods. So on that first method, we have in the public their letters. I'll talk later about the ARTP, AOTP. They've done a review of actuarial reports, and they've given us feedback, industry feedback. They have given industry feedback in December on the RSR, and that's Irish-specific feedback. You should be using that as a check against your RSR this year. And over June and April, they gave feedback on operational risk. They did a thematic review of operational risk, and they did a thematic review of cyber and IT. If you pick up other themes they've talked about that aren't just Dear CEO letters, they talked about stress testing, in particular non-life, but they did some life companies as well in Ireland. That's typically financial stress or unexpected stress. They have been doing a thematic review on outsourcing, a thematic review on QRT reporting processes. They're talking more and more about culture and beginning to talk about culture audits in the insurance space. They're currently doing it in banking. We've seen them do SCR calculation reviews. This time last year, I talked about anti-money laundering, procedural checks. That still continues coming through the system. There's still companies working through some issues on that as well. So I'm also kind of drawing a picture of a very busy regulator, very well resourced, and very active in managing and regulating the industry. Jump gear again. SFCR is a public document. And the central bank last year was quite careful in that they did give feedback to some companies on the compliance of the SFCR. They didn't really do a quality review or any quality feedback on that. They left that to EIOPA. One thing that people mightn't realize is the CBI does now have a register of all SFCRs. It's on their website, publicly available, and there's 187 documents. The eagle-eyed might know that there's 196 companies in Ireland, and 187 is less than 196. So there's some companies that actually haven't got their public SFCR up on the central bank's website. If you kind of watched all the detailed correspondence back through the year, they did mention that they're only loading SFCRs they were happy with. So that suggests maybe these companies are going through a transition or there's something else going on. We had a quick look at them. They're often smallish companies or captive managers, so we don't see a particular reason for those being excluded, but they are excluded. So useful reference for you if you want to look for an SFCR, you can Google them and they will eventually find them through the company's website. That's the rule. But there's a shortcut through the website of the central bank if you want. And I tagged it already. EIOPA has published feedback on SFCRs across Europe, a 19-page document, quite readable, and it gives you some ideas of areas you might want to improve. It might be worth a read this year because the second SFCR might be harder than the first SFCR because you'll have more comparatives in it. So thinking of how to actually communicate those comparatives. They've mentioned putting in last year's QRTs and this year's QRTs is not good enough. That's lazy. They want you to make it easier, narrate through that stuff. Right, so let me try and gather together hot topics over year end. What's going on? One thing that's not going on but has changed on the 1st of January is if you're doing your technical provisions, you have a discount rate. If you have long-term business, you care about the ultimate forward rate, the UFR. It was 4.2% and it decreased to 4.05% on 1st of Jan. So all things being equal, your long-term guarantees went up in value over midnight, 31st of December to 1st of Jan. That's been well flagged. We flagged that through the year ourselves. That's an EIOPA piece, and that's expected to happen again next year. There is now a glide path that they will probably decrease it by 15 bips again next year, and once it gets to 3.6%, there's a pause and see will they continue to do it. So again, get ready for that. That's an ORSA hint. When you're doing your ORSA, do some UFR testing. The one thing that has changed is there's 4 new annual QRTs this year. Sorry, they're not trivial. They're the variation analysis. So it's variation analysis in investments, own funds, and your TPs are kind of the main headlines of the 4 forms. So you have to be able to explain what you had last year, this year, and the movements in between. So that might require some more calculations and some more work. The format of the external audit opinion is now longer due to IASA guidelines changing, not the rules changing. So when you meet your auditors, they'll talk a little longer and explain a little more. It's now a 5-page opinion that goes to your financial statements and your Irish reg returns to the central bank. It used to be a page and a half. Asset look-through continues. So I've just talked up the central bank and data analytics, and the biggest thing that they get now is asset data. Guess what? There's a lot of pressure on getting more and more asset data. I divide into 2 parts. There's the reporting needs for your QRTs, which was a lot of the early debate. But secondly now, if you're actually calculating your SCR, the market risk component needs asset data to apply the stresses. And we've seen over the last few months the central bank focus on life companies, having focused on non-life companies previously about corporate bonds. Because corporate bonds information you need for stressing in the SCR is different from the information you need for the QRT reporting. So again, just word to the wise there, be good at stressing corporate bonds and also reporting on them. Tax is becoming kind of a secondary issue now that we're getting more used to Solvency II. Yes, we're good on deferred tax asset. Yes, we allow for deferred tax liability. And we've done a briefing note over the year on the loss absorbing capacity and deferred tax and the SCR. A lot of companies are taking a prudent yet slightly simplistic approach to that, which might be okay, but prudent and simplistic mightn't be what Solvency II really wants. They might want you to get to the facts. And the other piece I picked up around industry and having sat in on some other briefings, external audit, hot topics, they'll speak for themselves. I'm sure the auditors will have their own briefings, but I am seeing them talking more about reliance and interaction with group, because of Solvency II is often a group exercise as well as local subsidiary. They are talking a lot about timing of year end. They got through 196 companies in a pretty tight, rammed up against the May deadline last year. So I suspect you've already had your conversation with the auditors. They're being a bit more careful on what week they allocate to you and demanding that's the week you actually work with them. They can't do everything at the last minute. And then the technical issues under external audit, we've seen them, as has the actuaries, talked about contract boundaries. Reinsurance companies are still working through some of that issues. Risk mitigation techniques, documentation and support for that. So where something is reducing, you need a lot of audit-proof evidence that that is a risk mitigation technique. Look through, again, talked about already, and mass lapse and expense shocks are also a technical topic we see auditors talking to the likes of us about. Okay, and then to change gears, they're kind of the hot topics, but then what are the kind of hot people? The hot people are your actuary. The central bank wrote to the industry and copied all Hove in December saying, "Dear Hove, we have a domestic actuarial regime. You have to sign an opinion. Please change it." Say it again, they're asking us to change it. They've given us permission to add extra text. "Dear board, do not be alarmed when I've changed your actuarial opinion." The genesis of this and the trigger for this is the central bank has asked for that. They've asked that and I'm using my language now in shorthand, they've asked that the actuarial opinion is somewhat more a standalone document. So it does include things like how we've looked at materiality in assessing the TPs, and it does ask the Hove to call out reliances in the AOTPs, even if they're called out in the actuarial report itself. So they're looking for a little bit more bridging. And they've asked the Hoves to call out material concerns in the AOTP, even if they're called out in the report itself. And again, reminding you that the central bank doesn't get all the reports, it does get all the opinions. So it might be just a communication subtlety we're dealing with here rather than a fundamental change. But just word to be nice to your Hove. Always be nice to your Hove, but be nice this year as well. Read that letter so you understand what we're trying to deal with. I guess the external audit agenda is what's changed for year two. So their audit approach can change in year two, in terms of their approach to the control environment and the audits they want to do. But I do still think that the auditors are going to continue to demand data. Data is becoming the hot topic for us all because it's evidence-based for all the calculations. And I guess what's the management talking about? Well, it's 2 weeks shorter, and you better be 2 weeks quicker this time next year. And really now with the volume of paper, the directors are kind of saying, that little pause to say, just help me out. What are the judgment topics here? I'm the director here. Help me out with the stuff that I need to actually spend time on. So finding a way to percolate up the judgment areas. Is it interpretation of missing data? Is it interpretation on methodology we're not sure on? Is it interpretation of assumptions that are hard to set? Is it interpretation of the accuracy of the system because this is held together with string? Help me out here. And it's linked to that, who am I really relying on? So I guess that's really the gathering it together of how to prepare for the next few weeks and a few months as you go through year end.
Good morning, everyone. Now that Mike has taken us through year-end 2017 and all of the work that's going on there, I'm just going to shift the focus a small bit and talk about non-reporting regulatory themes for 2018. So this is what I'm going to talk about. The first topic, outsourcing, Mike touched on briefly there that it was a hot topic for 2017, and we would definitely see that as a key area and a theme to keep in mind for 2018 from a regulatory perspective. To give a bit of background on this, there was a survey last year, a cross-sectoral survey on outsourcing issued to all insurance companies. And on the back of that, there was a cross-border thematic review for life companies here in Ireland. So a number of companies would have been subject to that review. And those companies are now starting to see the feedback come out in the last couple of weeks. So it's definitely high on the CBI's agenda. And the type of areas for 2018, I think, that all companies should be looking at are things like the service level agreements. We're used to having those, the KPIs, those kind of things, but really re-examining the level and depth at which you have those KPIs and SLAs would be important. And also looking at oversight in terms of even what committees have oversight of the outsourcing arrangements, whether that's audit committees or other committees, it's worth re-looking at that. And even maybe considering how much you might want to incorporate outsourcing more explicitly into risk appetite frameworks. So definitely one to watch, I think, for everybody in 2018. Another regulatory theme that we expect to continue this year is the group and local issue. So a lot of companies here are subsidiaries, and the life of a subsidiary means that you always have that challenge of trying to keep the group happy and trying to keep the regulator happy. About 2 weeks ago, Sylvia Cronin spoke at an INED seminar, and she talked about examples where there were possibly decisions and transactions being, I think the word she used was rubber stamped by boards when they had been proposed by group without going through the necessary risk management considerations. So I think it's definitely something that we can expect to continue to hear from them over 2018. The next one's conduct risk, risk culture and recovery and resolution. I'm going to go into a bit more detail in a moment. But just to say there are many other regulatory themes for 2018, and I won't go into huge detail, but to call out a few, the likes of internal model companies. When you've gone through the IMAP internal model approval process, it's so vast you're tempted to think that you're done then, but we forget that the review cycle is there as well, and a lot of companies will be going through that review cycle with the regulator this year. Another hot topic from a regulatory perspective is cyber risk. I don't think ever really went away, so that's certainly going to be a theme, I think, for this year as well. And then finally, the role of the INED. So going back to that seminar 2 weeks ago, of which Sylvia Cronin spoke, she did remind us of the importance of that independent thought process and that ability to challenge senior management and assess the adequacy of control functions, and that ability to really understand the products being sold, the markets, and the conduct risk that goes hand in hand with that. So that leads me on to my first topic, which is conduct risk. So when we talk about conduct risk, I see it really as any risk that arises due to a company or a distributor conducting their business in a way that doesn't treat customers fairly or doesn't ensure that customers are treated fairly. And to give a bit of background in terms of the timelines and where we've come from, even before the timeline I have here on the slide, I think it was December 2015 when the CBI published a paper on best practices and principles for life insurance business distribution. So that was kind of earlier on we've heard there's been movements on this. And then in July of 2016, they signposted to what's up on the board these preparatory guidelines for the IDD, the Insurance Distribution Directive. And they have come in on the 1st of January, I think it was actually the 3rd of January maybe, but start of 2017, those preparatory guidelines came in. So that's in relation to the IDD, the Insurance Distribution Directive, but the preparatory guidelines are specifically around POG, which is Product Oversight and Governance. So they have been adopted by the CBI and they are live now. In March, the CBI launched their CPRA model, that's the Consumer Protection Risk Assessment Model, and that very much seems to be kind of an intensive and intrusive supervisory model where you could expect to receive reviews, whether it's on-site inspections or interviews, that kind of thing. And we know that a number of companies have been subject to these CPRA model assessments at this stage as well. So where we are today in March, 2 weeks ago was to be the date for the IDD to be implemented. That got delayed because they're still, I suppose, arguing over wording. And now it's October is the new implementation date. So it's just under 7 months away. So that's the new date for the full IDD, which goes beyond POG. It includes POG, but goes beyond it. So we've a bit of time to get ready for that. So where are we now? As I said, the POG preparatory guidelines are in place today. The IDD will be in place within 7 months, and so it's not really surprising that the CBI has stepped up its supervision in this area. They're actively looking at it. They have done targeted risk assessments, and so POG for sure is an area where, for 2018, where companies should be looking. And what do we mean by POG? I kind of see it as covering these 5 key items. I won't go through them all, but just to mention a few. The product approval process, that's where we're looking at the likes of target market identification and also product testing. And it seems that in that we're kind of moving away from the old idea of caveat emptor into a new world where we're actually thinking about the outcomes for consumers and scenario testing around the outcomes for consumers. So it's quite a cultural shift in that sense. And it's important to note that these requirements are for the insurance company. So you can be tempted to think the IDD is all about distribution, but actually these requirements apply to what they call the manufacturer or the insurance company. So these are very much for insurance companies to look at. But you do need to engage with your distributors as well because they have requirements too, but also you have requirements in terms of providing them with information, your process for selection of distributors and monitoring of them. My next area of topic is risk culture. So risk culture is without a doubt an area of increased supervision for the CBI at the moment. I think Mike mentioned earlier the newsletters that the central bank issues, and in their December newsletter they talked about this risk culture assessment model, and that's what I have up here on the screen. This is their model, and it consists of those 4 components, and it's very much looking at forming a view on your culture, looking at culture as a collective of behaviours and trying to form an assessment of that. And to do that, they have a risk culture assessment tool, and that's being road tested at the moment with the banks, and after that it'll be moved on and rolled out to the insurance industry. Unless, I suppose, if they feel that a company has adequately assessed their risk culture themselves, perhaps you wouldn't be subject to it. But that's the idea, is that they will have a risk culture assessment tool. And in their first article in December, it was the first in a series of articles. They're going to do a couple, so that just shows how high it is on their agenda and that it's definitely going to be here for 2018. They talked about leadership, and I definitely agreed with their sentiment. They talked about, well, we're used to culture as tone from the top, organisational values, they're on the wall, all of that, which is great. But it also mentioned that the importance of what they've described as mid-level leaders. So they're the division leaders, the team leaders, because if you don't tap into that layer, you can forget having risk culture at the lower levels of the business and the front line where the real risk management takes place. So I thought that was certainly useful, and I think we can expect to hear more from them on this over 2018. This brings me to my final regulatory topic. So this is recovery and resolution. You often hear regulators and others talking about a firm's financial resilience. And sometimes they're talking about stress and scenario testing. Other times they're talking about this, recovery and resolution. And what we're talking about here is recovery planning. And a recovery plan is really a document that sets out the options that would be available to you should your company come under financial stress. So it's like a business continuity plan in a way, except instead of talking about IT failures and loss of buildings, you're talking about breach of SCR and all of that kind of thing. Resolution then is a different stage. It's kind of that point of no return, the point beyond which you're no longer viable. The regulator is going to be running your business. It's a completely different zone. But recovery and resolution planning is not new, certainly not new in insurance. For the last, I'd say, at least 2 years, we've been looking at it in terms of what's going on in this space, and we produced a paper about various options and strategies that could go into these plans a couple of years, about 2 years ago now. But since then, the regulatory landscape has moved on, and we feel that it is a hot topic for 2018, and there have been some important developments from a regulatory perspective, and that's why today we said we would highlight those. So just to give a bit of background about where we are in terms of regulatory developments on this, there are requirements at the moment for G-SIIs. These are the global systemically important insurers. They are required today to do recovery and resolution planning. So that's happening today. We have a lot of experience there, lessons to be learned. So we're not coming at this from a blank page, if you like. I know Milliman have worked on a number of these. The Financial Stability Board have issued guidance. So there is a whole chunk of material on this. In terms of the position in Europe, we have the UK. They introduced Fundamental Rule 8, I think, in 2014. And that, in theory, required recovery and resolution planning to be done by all insurers. It didn't say anything about large, small, anything. In practice, the way it's been implemented is that the PRA, the regulator in the UK, has only engaged with the large companies. So that's where it's at the moment, but there is a rule there. Across Europe, these are just a few examples to highlight what's happening, where national regulators have made moves, kind of gone solo in a way, and decided to put in their own national laws on this. So France have a national law in place on recovery and resolution planning. It doesn't require it to be done by all insurers, but it sets the basis for the ACPR, the French regulator, to require it from all insurers, and they can use that as they wish. So there's something there that covers everybody. The Netherlands are similar. They have a bill that has been passed, and so it's expected to come into national law soon along the lines of the French model. But what's interesting, I think, in the Netherlands is the DNB, the Dutch regulator. If you want to set up a life insurance company or a non-life company in the Netherlands, you have to include in the application a recovery plan, which shows where their thinking is at with this. They obviously see it as a key part of business going forward. And then there's others like Romania who've gone ahead and implemented recovery and resolution planning for everyone, but that's just one particular example. So where we are in Ireland, there's no formal requirement to do recovery and resolution planning today. However, we do know it's very high on the CBI agenda. We've seen comments from Ed Sibley and various others from the central bank who have mentioned this over the last couple of years. We know that pressure is increasing and that they're actively looking at this. Against that backdrop then, we had the EIOPA consultation. That took place about a year ago, and then about in the summer of last year they issued their final opinion. So there was a consultation process. A few of us from the office were involved in preparing a response to that for the EAA, and ultimately we got an opinion which was that they recommend a harmonised recovery and resolution regime for all of Europe, for all insurers and reinsurers. And the scope would be those subject to Solvency II is what the proposal is. And they set out in a lot of detail what that would entail. And then just to let you know, the IAIS, that's the International Association of Insurance Supervisors, it's the club that the regulators are in. They issue these ICPs from time to time, Insurance Core Principles, and they have two out at the moment, ICP 10 and ICP 12, on recovery and resolution planning. Now they're longer term and regulators don't have to adopt them, but it's just kind of adding to the pressure when you look at the temperature check for all of this. So what will it mean if it comes in? For those of you who are already involved, be it with GSIs or for other reasons, then you'll know that you have two aspects in terms of the proposed model by EIOPA at the moment. You have the recovery plan, and that is essentially a very big document that is drafted by the company, and it sets out in great detail the options available to you should your firm come under financial stress. And to do that, you're going to need inputs from all over the business. You're going to need projections from actuarial and finance. You're going to need help from risk in terms of talking through these particular situations. And then it actually requires you to go into a lot of detail on the practicalities. Well, is it legal to implement that transaction in that scenario? And what legal consultants would you need to use? Or do you have the legal team in-house? That kind of thing. Operations and IT, do you have the data ready to implement that transaction should this situation arise? Are your business operations very interconnected, and would that make it difficult to do this transaction? Those kind of things need to be really fleshed out. And even looking at the timing, so how long would it take to implement these options? How long would it take for the impact to come through? How did it impact P&L, liquidity, solvency? Going through all of that. And then it even gets into the details of people. How will it impact your staff? What's your communications plan? So in this scenario, you've come under a lot of financial stress. How are you going to communicate the plan to everybody? And the media are going to be calling, what are you going to say to them? So it's really, really detailed plan. And at the heart of the recovery plan, I think really is strategy. And I think when you're doing recovery planning, you're getting to the core and the substance of the business, and you're asking difficult questions and making decisions about situations that you hope to never be in. So on the one hand, you're trying to get input from all around the business, and then on the other hand, you're trying to keep it to a somewhat targeted group, because these can be somewhat emotive questions in terms of what business would you be willing to sacrifice, that kind of thing. So it's definitely an insightful process, but a challenging one and a lot of work. The resolution plan, under the banking model, the BRRD, and indeed under the proposed approach by EIOPA, the regulator would draft the resolution plan. So that may make us think, great, we won't have much work to do on this. Unfortunately, the experience of GSIs is that that's not entirely the case, that there's a huge information gathering exercise where the regulator will want to know everything about your legal entity structure, everything about your organisational structure, how connected it is. Because remember, in this situation, in resolution, the regulator is going to be making the decisions, and so they want a plan to know what they will do in those situations. So they need a lot of information from you. There's also an assessment where you look at the barriers or impediments to resolution. So if you had a particular business unit or transaction that made it all very complicated and difficult to dismantle in the case of a resolution, then that might need to be highlighted. And some of the GSIs have had to make changes to their structure to make sure that to pave the way for resolution if that situation were to arise.
Okay, I'm going to do a little bit of a roundup now of some of the other wider themes and things to look out for in 2018. But before getting into that, I wanted to start and say a few words about IFRS 17. I think as I've subtitled it here on this slide, like it or not, there will be no escape from IFRS 17 in 2018. I have to confess, it's not something that really fills me with a lot of excitement, but it is a real issue for business, and it's something that we all have to get to grips with over the course of the coming year and beyond. So in terms of the timeline, I guess we're looking at a period that's going to run to 2021. I mean, the key date here is January 2021. That's the go-live date. But when you work back from that, you find that actually things need to be done sooner than then. In a sense, you need to be ready by the end of 2019, start of 2020, because when you get into having to produce comparatives and so on and so forth, and at least having the capability to do that, you need to be substantially there by the end of 2019. So, you know, that 2021 sounds like a long time away. The end of 2019, not so much. So yeah, as I said here, you sort of need to be thinking in terms of 2019 really as the important date here, and not be lulled into a false sense of security by 2021. There's also some interaction here with IFRS 9 in terms of how that's going to sit on top of IFRS 17. Essentially, you have two options. You can overlay now, or you can delay to the end. Just in the interest of time, I won't get into all of that. We're certainly happy to talk to people about that one-to-one. Just very briefly in terms of where the lie of the land is on this, and we did a survey last year, so I suppose it is a little out of date, but I think it still has some useful insights and useful information. I think one of the key things that it told us was there wasn't a lot of agreement or consensus around quite a few things. First of all, in terms of budget estimates, there were some wildly varying budget estimates, even within what you might have expected to be similar types of companies, which sort of indicates that perhaps the people hadn't really got their arms around this and hadn't really got a good handle on it just yet. Also, no clear consensus on where you start in terms of building your models. So some people were saying, well, I'll start with my Solvency II models. Others were saying, well, I have embedded value, EV models that I could use. And others were saying, well, I have my existing IFRS or GAAP reporting models, and I'll start from there. But one thing that did come through was that there was consensus on there would be very significant actuarial involvement in the IFRS 17 project. I think it is, even though it's a financial reporting standard and you would expect it to be all about the accountants, I think that's not really the case in this case. I think the actuarial component and indeed the data and IT component, both of those components are very central and very core to the IFRS 17 implementation effort. In terms of concerns, again, I won't get into this in any detail. I've listed them there on the screen. I think if we had to pick out one, I'd probably focus again on systems and models. Again, there is can't emphasize enough that there is a huge system build and model build involved in IFRS 17. This is not just a tweak to your existing processes, your existing systems. And that leads to the last point there again in terms of timescales, which I've mentioned already, and availability of resources I think is also a key issue. We're already starting to see the same sort of pressures build in the market in terms of what we had back with Solvency II, with actuarial contracting resources being in high demand and in short supply, and also just the ability of some of the audit firms to resource up as well, I think will be a challenge. So there's definitely going to be pressure on resources. That was a snapshot of the readiness of the industry last year. So moving on, just in terms of the roadmap, again, running through this relatively quickly, there's a lot to be done between now and 2021. Just again, to pick out a few key points here. I suppose the key message, just to hammer home again, really, is if you haven't really got started on this, you're already late. You really need to have been doing those initial steps, or have those initial steps done by now, and be moving into the 2018 box here. So in terms of getting a handle on understanding what this will mean for your business in terms of training, initial assessment of what it means for the business in terms of the financial impacts, the business impacts, the impacts on your products, figuring out how you classify your products and having some sort of a decision tree for that, looking at your methods, looking at how you're going to aggregate. All of these issues are things that we really need to have kind of got to grips with at this stage. And then as we move forward from here, 2018 into 2019 and 2020, It's then about sort of turning that into reality. So now that you've got the conceptual framework, you've got your arms around that, it's then how do I actually implement that with system build, system development, system testing, developing your governance structures around that, building in the ability to forecast as well on an IFRS 17 basis, which is something that sometimes gets overlooked as everyone is focused on just producing the point in time balance sheet numbers or the historic P&L numbers. Ability to forecast is also going to be a key one. So, at the risk of labouring the point, an awful lot to be done in a very short space of time. One thing just to mention in terms of resources to help you on this journey, the IASB, the Standards Board, has set up what they've called a Transition Resource Group, which is a group of about 12 people or so. They're sort of drawn from some of the big multinationals, so the technical accounting leads in the big multinational insurers, and the technical accounting leads from some of the big consulting firms. And they get together regularly to discuss the technical issues, so to help you understand the nitty-gritty of how the standard should actually be applied in practice. They're meeting regularly. They met in February. The minutes of that meeting are out, and we've produced a sort of a summary of that as well. The meeting again in May, and we'll continue to monitor this closely as a key source of information and help in terms of understanding the practicalities of the implementation. Milliman is represented at these meetings. We've a consultant, William Hines, who represents the Global International Actuarial Association, and he sits in on these meetings. So we're very, very plugged into this, and we'll be able to share that knowledge with you as the years unfold. So as if you haven't sort of got the hint by now, there's I think a fairly pithy quote here from Martin Edelman, who is the chair of this TRG. I suppose just setting expectations. They were very clear that, look, this is going to be expensive, it is going to be an operational burden, there will be costs, but don't expect us to try and water it down because of that. You're going to have to get on and implement it as it stands, and you're on notice, you have been warned. That's really the message coming through. So in terms of helping you then, in terms of how Milliman can help you to get to grips with all of this, first of all, we have a readiness assessment tool, which I mentioned earlier, gave it a plug at the start. There will be a demo after the meeting here, the briefing here this morning. It'll be familiar to, the look and feel of it should be familiar to a lot of you, because I know a lot of you were users of our similar Solvency II readiness assessment tool. So it's the same sort of idea. It's a self-assessment tool broken down by the different work streams that allows you to score yourself and assess yourself and understand where you stand, understand where the gaps are, do some project planning around that, and also includes useful links to the standards as well, so that you can check and understand and reference what the requirements are in each of these areas. We've also produced quite a few other resources. We have briefing notes, and we will continue to produce briefing notes on various topics related to IFRS 17. We're conducting surveys, we're providing training, and the readiness assessment tool I just mentioned. And you can find all of this material on our IFRS website at the address there at the bottom of the slide. So, as I said at the outset, I think there really will be no escaping IFRS 17 this year. Like it or not, it's here. We've got to deal with it. I think there was some hope in certain quarters that, based on the experience of Solvency II, which got delayed on a couple of occasions and ultimately ended up being implemented, I don't know what it was, 5 or 6 years later than it was originally planned to be. There might be, I think, hope in some quarters that we'll see a similar situation arise with IFRS 17. I don't see that happening. It's theoretically possible that the European Union, the EFRAG group in the European Union, could decide to postpone it for European Union adoption. I think it's highly unlikely. So I think you have to plan on the basis that this is coming, and it's coming with the timetable we outlined earlier. Okay, so that's probably enough on IFRS 17. Just to shift topics slightly and talk in terms of the regulatory agenda. I'll say a little bit about the agenda for 2018, both in Europe and in Ireland. Starting with Europe, and I guess maybe moving here across from left to right on the slide, we've set out here the key themes from EIOPA, what they've said they're going to be focused on this year. This is sort of largely drawn from their published work programme for 2018. So not surprisingly, first of all, the prudential framework gets prominent mention. And there's a few aspects to this. A lot of the heavy lifting has already been done in terms of putting Solvency II in and getting it up and running. But no sooner is it in than it has to be reviewed. So there's a couple of things going on there. First of all, there'll be a review of the SCR, which is ongoing, and I'll say a little bit more about that in a moment. There's also going to be a review of the long-term guarantees measures that are built into Solvency II. So for anybody who's availing of things like the matching adjustment, the volatility adjustment, the transitionals, and so on, those are going to be reviewed in 2020. And EIOPA will contribute to that review. And also, obviously, the EIOPA will also contribute at an international level. Conduct, risk and regulation and recovery and resolution planning, Bridget has already taken us through those in some detail, so I won't say anything about them here other than to note that they are high on EIOPA's agenda. I mean, what we've listed here on this slide are the hot topics, the priority issues from their work plan, so they are definitely going to get attention this year. Just in case you didn't know as well, you can expect another insurance stress test this year from EIOPA. There will be a Europe-wide stress test, which typically then impacts the larger insurers here in Ireland, because of the way that these things are typically constructed. In order to hit the coverage levels, the central bank will order a certain number of companies here to participate, and they generally do that by picking the biggest ones as the kind of easy wins, or the easy way to get to the coverage level they need. Supervisory convergence is an important topic for EIOPA, so they are trying to foster more harmonisation across Europe in terms of how supervisors act and what they do and how they do it. It's still a patchwork, even though we're supposed to have a harmonised regime under Solvency II. That might be true up to a point when it comes to the legal text, but the actual implementation and the way in which supervisors interact with their supervised companies still varies quite a bit across Europe, and EIOPA is determined to try and standardise that. And in the InsurTech space, they have said that they will launch a thematic review on industry's use of big data. So we'll see what comes out of that. And of course, cyber risk is also on their agenda, both in terms of how they should supervise that, but also what it might mean for companies in terms of new business opportunities, and then what it might mean for them in terms of regulating those new lines of business. So just to say a couple of words about the standard formula review, because that is very topical at the moment. So why is it being reviewed? Well, it was baked in when Solvency II was brought in, first of all. It was baked in that in 2018 there would be a review of the standard formula, with a focus really in terms of trying to simplify where possible. So that's been happening. That process kicked off last year. The European Commission, as was the case with the implementation of Solvency II in the first place, it set out calls for advice, went to EIOPA and said, okay, EIOPA, we want your advice on what we should do. And EIOPA has responded, has provided 2 sets of advice, most recently just last month. And those key proposals from EIOPA are as follows. Now, bear in mind that these are EIOPA proposals, so they're not gospel. They may not find their way verbatim into the final text when it's issued later this year. But clearly, the EIOPA proposals will carry a lot of weight, and there's a good chance that they will survive into the final version. So what have they proposed? Well, probably the most important one, because it affects pretty much everybody, is they propose some very fundamental changes to how the interest rate risk module works in the standard formula. They've said that the current approach is not fit for purpose in a low interest rate environment, and they've proposed a new approach. They've been upfront in recognising that what they're proposing is going to have material implications, and for that reason they're also proposing a 3-year transition, a 3-year phasing in. We touched on deferred tax earlier. Mike mentioned it, the loss absorbing capacity of deferred tax. There's an awful lot of inconsistency and very little guidance on this, official guidance, so they're trying to sort of corral people a little bit more in terms of how people approach this element of the standard formula calculation. They're proposing to keep the longevity and mortality risk factors unchanged, which is important because, or is noteworthy, I suppose, because at one stage they were, in their previous version, proposing to materially increase the mortality risk stress factor from 15% to 25%, which would have been very substantial, but they seem to have rolled back on that. They are, however, proposing to change some of the non-life premium and reserve risk factors. So for non-life insurers, there will be changes to some elements of the calculation, depending on the line of business you're writing. So some of the lines of business that are affected are things like medical expenses, legal expenses, credit and suretyship, those sort of things. And then they're proposing simplifications in lots of places. They're two very long documents. You put them together, there's I think over 800 or 900 pages of text for VIOPA. So there's a lot in there. There's a lot more simplifications and so on. But these are the sort of the headlines. Okay, then looking at the CBI's agenda here in Ireland. Again, we've touched on some of these already, but just to briefly mention them. In terms of their core supervisory function, they've been very clear in a couple of speeches and a couple of publications that they're focusing more and more on what they call business model sustainability. So if they think that you're in a business where you don't have competitive advantage, where it's difficult to see how you're going to make money on a long-term basis, how you're going to be, as they say, capital accretive on a long-term basis, that's something that they'll take a keen interest in. Brexit clearly is a big issue for the regulator, both in terms of handling new authorizations. So it's welcome that for the first time in a long time we have a material number of new authorizations before the central bank, mostly Brexit related, not all, but mostly Brexit related, which is great because clearly the number of authorised insurers here has fallen very dramatically over the last decade, and so it's nice to see some new blood. It also affects them in terms of then interacting with the people who are here at the moment, contingency planning being the main point here, asking people who are affected or potentially affected by Brexit what they're going to do about it. Outsourcing, Bridget already touched on, so that is definitely a key focus. It has been and will continue to be a key focus for them, as will non-life pricing and reserving. On reporting and disclosure, Mike spent a bit of time earlier talking about the end 2017 details and specifics of that, but I think just at a higher level, really the message for me, I think, is that it's clear that the Central Bank have made some very clear pronouncements recently that they have been tolerant with the quality of data that they have been receiving in terms of the QRT submissions so far, but that their patience is running out. And they've been pretty explicit that there is a director's accuracy statement that accompanies the annual submission. And if they find cases where directors have signed an accuracy statement and then there are issues, material issues with the data, that will be something they will be taking a keen interest in. And cross-border supervision is another key area of focus for them because I guess Ireland is both a heavy exporter and importer of insurance. An exporter probably, well, both on the life and non-life side in terms of companies here doing business abroad. So they need to be plugged in with their counterparts elsewhere in terms of the other regulators. But also, and I think probably of more concern to them, we're an importer, particularly on the non-life side, where there are quite a few insurers who are headquartered elsewhere in Europe writing business here, particularly in the motor market. And as we all know, there have been some high-profile failures in the past, and it's an area that the central bank is taking a very keen interest in terms of how they can better coordinate with the other supervisors, given that they don't have a prudential supervision role in terms of those other insurers. Okay, very briefly then, just to finish up, other hot topics for 2018. So moving away from, the regulatory agenda, the financial reporting agenda, both of which obviously are important to most people here in the room and will drive a lot of activity, but there's wider life beyond regulation and financial reporting, and out there in the real world, what's going on? Well, InsurTech is definitely a hot topic for 2018. Now, as I said here, it covers a multitude. It's one of those words that can mean anything you want it to mean almost. I think up to now, everyone's talking about it, but not very many people are actually doing a lot in terms of really, I think, for insurers trying to future-proof their business against the potential disruption that will come from new entrants, and by new entrants I mean new entrants from outside the sector. It's probably more of a front-end than a back-end sort of activity, more of a front-end spend than a back-end spend in terms of systems, so it could be the client-facing piece really that probably sees the initial investment here. And there is a bit of a tendency or a bit of there can be a risk that people think of it as something that's really a non-life, more of a non-life than a life topic, but I think there are definitely life assurance related issues here as well, and things that are topical for the life industry. So that's going to be an area to watch. Capital management, I think, is certainly a drum we've been beating for the last couple of years, ever since Solvency II was first put into place. We certainly feel that there's an awful lot that can be done in this space by firms. The firms really are only starting to scratch the surface here in terms of how they can optimize their capital under Solvency II. And that's capital both in terms of available capital resources, so how you fund yourself. So, for example, things like subordinated debt have been there's been very slow take-up, which is quite surprising, really, because it's very attractive at the moment. On the required capital side, there's certainly a lot you can do in terms of optimizing your SCR, the various levers you can pull, like asset liability matching, hedging, reinsurance, changing product mix to get diversification benefits and so on. Monetization of in-force assets and various things like that. So there's lots that can be done, and there are some easy wins. I think there's a temptation sometimes to think that this is very complicated and people shy away from it, but that's not necessarily the case. In the wider sort of business sphere then, I think, competition and consolidation has been a theme, continue to be a theme. We've seen a lot of M&A activity, both life and non-life, in recent times. We've seen the emergence of the appearance here of some of the consolidators. We have people like LCCG, Monument. We've had Phoenix now come in and buy Standard Life in the UK, which will have knock-on implications here. And that's a trend that's only going to continue, I think. On the non-life side, we talked a little bit about that already in terms of pricing pressures. And it's something of a dysfunctional market, I think, in some areas, and that'll continue, I think, in the short term. And for life companies, the challenge, as always, is in the current environment is investment markets, both the search for yield in a low interest rate environment, and also with the recent wobble in investment markets in terms of investor sentiment for those life companies that are reliant on taking in savings business and investment business that could dent new business flows. And then finally, Brexit, well, kind of touched on that earlier from a regulatory perspective, but from a wider perspective, I think there will be knock-on implications for the industry here as a whole. We have seen, or will see, some arrivals in the not-too-distant future. We've seen some already, possibly some departures as well, who knows. But I think probably more arrivals than departures, and that will have knock-on implications, not least in the area of competition for talent. Again, combined with IFRS 17 and the pressures that's going to bring, having new companies come in on the back of Brexit, while obviously welcome, will definitely bring some pressures for firms as well. So just in the time available, that's something of a whistle-stop tour through the various topics. I think we'll leave it there in the interest of time. Thank you again.